Hey traders, Mike Zanger here. Welcome back to my How to Trade Like video series where I teach you how to trade like the top traders in the world. In my last video, which is part 1 of the How to Trade Like Dan Zanger, I talked extensively about the CANSLIM model, which helps you identify the strongest companies to buy. Now in part 2, I'm going to break down some of Dan Zanger's favorite chart patterns and show you exactly when it's time to buy these strong companies. Also, make sure you stay until the end of the video as I will share with you 3 technical trading rules that Dan Zanger never breaks. So let's get started. Now, Dan Zanger is a big advocate of using chart patterns to identify potential trades. He believes that chart patterns can provide a visual representation of market sentiment and can be used to identify potential buying and selling opportunities. Now, if you're a believer that stock prices can move in a predictable way, then you need to study chart patterns. So let me share with you some of Dan Zanger's favorite chart patterns and show you how to trade them. Now, the first chart pattern that Dan likes to look for is called a rounding bottom. And this pattern is a formation that occurs where a stock's price action forms a rounded shape. Now, the rounding bottom formation begins with a downward trend as the stock price gradually declines. Now, as the stock reaches a support level, the selling subsides and the stock starts to move up gradually. Now, the stock's price then moves in a range-bound fashion, forming a rounded shape on the chart. Now, as the stock price continues to move up, the buying pressure increases and therefore the stock price breaks out of this range-bound pattern, signaling a reversal in the trend. And this formation suggests that the stock's downward trend has ended and the stock is likely to move higher. And typically, it takes several months to form the rounded bottom. Now let me show you an example. Here's a chart of Apple, and you can see that the stock price has essentially been declining from $31, okay, all the way down to $23 here. So you can see this downward trend here, downward trend, and then it finds a support level right here around $23. You can see here, 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 here. Okay, so as it's going down, finds a support level. You can see this round shape forming. Okay, then the first resistance level that you can consider buying the stock is around 24 here. There's a little small minor resistance level. Okay. But in terms of the true level to buy in terms of the rounded bottom formation is actually right above the resistance line here, around 25.50, mainly because you can see here, this is where it broke, and then tried to go above this line, couldn't break it. Tried to go above this, couldn't break it. So you can see that it actually broke up around here. There was not a lot of conviction. It actually came back down, and then finally the conviction was right here when it stayed above this 25.50. So the rounded bottom chart formation, you can see this round shape, right? I'm drawing it right here, round, and going back up. The second chart pattern that Dan likes is called a flag. Now this chart pattern is a formation that occurs in the stock market where the price action of a stock forms a flag on the chart after a strong upward or downward move. The flag formation is usually preceded by a steep and fast price move called the flagpole and is characterized by a period of consolidation marked by horizontal or slightly inclined parallel lines that form the flag. Now, the horizontal or slightly inclined parallel lines represent a period of indecision by investors where the buyers and sellers are in balance and the stock is trading in a tight range. As a result, the stock price moves horizontally or slightly inclined, creating the flag shape. Now, the flag chart pattern is considered a continuation pattern, meaning that it is typically a signal for the stock's trend to continue in the same direction as the flagpole. Now, it's considered a bull flag when formed after an upward move and a bear flag when formed after a downward move. Now, let me show you an example. Here's a chart of Shopify, which shows both a bear flag and a bull flag. So first of all, you can see Shopify here. So the price has been falling here, and then it consolidates. So you can see this flag pole, and then this flag right here going sideways, and then a break right through right here. So you can see a bear flag right here. So the entry is to get in here. Now a bull flag, you can see a big strong upward movement here. So this is the flag pull, and then consolidation, consolidation, and then it breaks out to the upside. The third chart pattern that Dan likes is called a cup and handle. And it's a bullish chart formation that is characterized by a cup shape followed by a handle shape on the chart. Now the cup is formed when the stock's price declines gradually over a period of time, usually several months, creating a U-shape pattern. And as the stock reaches a support level, the selling pressure subsides and the stock starts to move up gradually, forming the left side of the cup. And as the stock approaches its previous highs, the buying pressure subsides and the stock starts to move down again, forming the right side of the cup. The handle is formed when the stock's price moves horizontally or slightly down after the cup formation. And this handle represents a period of indecision by the investors where the buyers and sellers are in balance and the stock is trading in a tight range. Now the cup and handle pattern is considered a bullish formation and is a signal for the stock's trend to continue upward after the handle is formed. And traders and investors usually watch for a breakout above the resistance level where the stock's price breaks of the handle to confirm the cup and handle pattern and to consider buying the stock. Now let me show you an example. Here's a chart of Netflix, and basically what you want to see here is this is the cup here. So it's been declining and then kind of creates like a cup, right? And some people say it's very similar to like a kind of a rounded bottom, right? So you can see there is right here, if I draw a horizontal line, there's a support right here around 506. So you can see this downward decline hitting a support level and then going up. So this is kind of like a mini rounded bottom. And if you think of it's a mini rounded bottom, you can look to buy right here. Okay, right here, once it breaks above this line. But the different part is this is the cup right here, and this is the handle where it kind of goes sideways. Okay, consolidated. So you can see this little handle right here. See this drop. So there's a resistance level right here. This is the handle, and then you buy right above here, and then it goes up. Before I end part 2 of the How to Trade Like Dan Zanger, I want to share with you a few technical trading rules that Dan never breaks. Number 1, make sure that the stock's volume is above average after the price breaks out. Never buy more than 5% above the breakout level. And finally, sell 20 to 30% of your position as the stock moves up 15 to 20% from its breakout point. If you like this How to Trade Like the Top Trader in the World video series, please smash that like button and hit subscribe if you haven't already. I would really appreciate your support. Next week, I will teach you how to trade like Testa, the Japanese trader multi-millionaire. I'll see you guys all in the next video.